Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit WilsonInvest.com. That's WilsonInvest.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Welcome back to Real Estate Radio Power Investing with Helen Chong today, who's talking to us about her experience as a broker and founder of, Helen Group?
Yes.
Yep. And also president-elect for CCIM for Northern California. So, Helen, on that note, let's talk a little bit about CCIM and what kind of tools does one learn, or if you're interfacing and utilizing someone on your team who has that background, what does one learn in CCIM, and how does that help you make good investment decisions?
So first of all, CCIM is like really one of the most prestigious destination in commercial real estate.
I guess we should say what the acronym stands for.
That's true. It stands for a Certified Commercial Investment Member. And only 6% of the commercial real estate agents have this destination. And every one of us.
It's nationwide.
Yes. Actually, globally.
It's global.
Yeah, this destination is global. And so as a matter of fact, to get this destination, it does take really rigorous classes. And for example, we have 4 core classes, and each core class is 4 full days. And every single person who took those classes will tell you they come up with a really big headache.
I don't think that's a good advertisement, Helen.
I know, but I would visit the classes, and then I would ask them, I was like, do you guys have a headache? They're like, yes, it's so much information.
Well, it's all the more reason to get someone on your team who's been through that, so you don't have to have the headache, right?
Yes. And I absolutely love it. I'm telling you, when I went through the courses, during the whole entire courses, I actually had, I think I went through 2 pregnancies. 2 out of the 3 pregnancies, and so I feel like my babies actually had gone through a lot of math and numbers, while they were inside me. So, but it's.
So how are they doing in those subjects today?
They are really good.
Oh,
with
good.
math.
Okay.
They're really good with math.
Maybe there is something to that.
Yes. And so with that, after you take all those classes, you also have to have a portfolio requirement. You have to complete either $30 million or $10 million transactions to show that you really have done it before you are even qualified to take this 6 hours exam. So it's a pretty long process. For me, of course, it took a little longer, 4 years, and on average, it actually takes about 2 to 3 years. And we always kind of joke around, it's like a PhD level in commercial real estate, just because there's so much analysis. But what it has done to me, to my work, is that it really took my level of analysis to a whole other level, because I already love numbers. I love spreadsheets. But this one I started doing, just picked out one analysis that they had taught me, which is a 10-year analysis. From here, I can analyze the current, based on the current number. I can use assumptions and then analyze the 10-year cash flow with, of course, different assumptions, because every single property has different ways of making it better, right? And then I can learn about what I can sell this property, probably can sell this property at about 10 years later. Then I can also see what is the IRR of this property, if it makes sense or not. Because cap rate is not necessarily equal to IRR. So, and then I can see what kind of loan program I can qualify for with this property, because buying apartment buildings to qualify for a loan is based on the income of this property. So just through that one spreadsheet, of course, there's 5-6 tabs, but through that, I pretty much can show everything to my client, and my client has really clear picture of what this property can do. And then we comb the numbers, each numbers down, and then say, okay, maybe we should adjust this assumption a little bit like this, make it a little bit more aggressive, or make it a little bit more conservative.
Let's dig into that a little bit, just as an example of how important, how complex it is to do a good analysis. Let's just take the subtopic of assumptions. Can you give some examples of some of the assumptions? Let's take a multi-tenant retail center. Okay. So what are some of the assumptions that you need to factor into your underwriting?
well, some of the underwriting we do is probably capital improvements, but then like a lot of time we want to look at the market and what is the rent increase that you can do. For retail centers, a lot of times you do a pretty standard like 3% increase, right, over years, and it's triple net. So the expenses is a little bit easier. To me, I think apartment buildings is even more complex because apartment buildings, you don't get to have the tenants pay for your expenses. So you really make sure that your expenses are calculated more conservatively. So we do assumptions based on like your expense is going to increase every year, and then you might have to put in some work onto the property. And in terms of the rental income, sometimes if this property, let's say, is way under market rent, but you don't want to say like in a year I can convert this whole apartment building into a market value rent property. So you want to kind of pace it over. Pace it out, and then maybe it could be a three-year project to get it up to the market value. But at least you can use this analysis to slowly and see what will happen if it takes 3 years, what will happen if it takes 5 years, etc.
Yes, and it's not a simple analysis. Some of these underwriting spreadsheets that we've done, and I'm sure you have too, are not just hundreds of cells, sometimes thousands of cells.
Absolutely. And the thing is,
imagine trying to do that by hand before spreadsheets existed. You couldn't. It was just impossible.
Yeah, but you know what? When we learned the CCIM analysis, actually we used it by hand. We did everything. We fill out every single cell.
You can't really appreciate
exactly.
it.
And then now, of course, we can just punch in the numbers. But in the beginning, we really did fill in every single box by hand.
Yeah. And I like to use the example of a multi-tenant, even triple net, where you don't have to estimate the expenses quite as much.
Right.
You do like tax insurance and you get reimbursed, but there are other expenses you don't. But we closed last year on a 103 tenant, 6 location industrial portfolio in Houston.
Wow.
And just one element alone is for all 103 tenants, you have to put in, when does that lease expire? What's the probability of them renewing? If they do it, what price is that going to be?
Exactly.
If they don't renew, how long will the vacancy be before you renew it? And at what price will the new tenant pay?
Yeah.
And that's just for every tenant.
Exactly.
That's times 103. So
that's true.
So you got to have somebody in your team who is willing to do it, knows that they have to do it to give you a good recommendation, and for what to invest in, and have the ability to do that.
Yeah. And you have to look through the leases, and then just like what you're saying, like how long is the lease, and then when are they going to expire? You're going to look at like if it's possible to raise rents, or are they Section 8 tenants, and things like that. So there are definitely a lot of factors. I notice a lot of people are missing the vacancy rate. They assume that, oh well, right now it's 100% occupied, then they don't factor in vacancy rate, but you definitely should, because it cannot be 100% all the time.
You mean vacancy rates go up and down with market cycles?
Yeah. Yes, but of course sometimes it's hard to do it by the year, but we always use a little bit more conservative approach to add in vacancy rate as well.
So Helen, how do you advise an investor about what asset class to invest in?
Yeah, so again, it really depends on the client's risk appetite. I don't really dictate that for them. I let them tell me what their risk level is. So I have clients who I would always try to push them to expand their horizon in a way. But at the end, you could tell just by saying, like, oh, I don't really like that. I don't really want to deal with these kind of tenants or these type of assets. So I think a lot of people, they don't know what they don't know. So you have to let them see it and then decide if they can accept those type of asset class. Yeah. Everybody wants cash flow and appreciation and best tenants.
And no risk.
Yeah, and no risk.
And next door.
Yeah. And it just does not exist.
I haven't found that so far. So that's right.
Yeah. And everybody wants the best price too. Wants the best deal. And then if you are chasing after the best deal, you probably will never buy a property. No.
Yeah, I find those different factors that you mentioned, they're really different circles, right? And what you're looking for is where they intersect as much as possible, and that's how you can best advise a client what to do. We found that few years ago, multifam was getting overbuilt in most primary and now secondary cities in the country. And when a developer builds something new, they only do Class A.
Yeah.
So that really kind of got out of hand. But I find a lot of investors who maybe aren't as experienced have in their mind that that's the only thing they're interested in, because the old adage of everybody has to live somewhere. But guess why they live where they do? It's because of all the non-multifam commercial properties that are around them, right?
Yeah.
The shopping centers, the employment, the offices, every place where they work, all of that. So they're really tied closer to commercial, non-multifam commercial than they realize. And then that's another reason why we do this radio program, and why we also have our Baycom.club, and you do a lot in the education arena, is to help open people's minds to thinking outside of their comfort zone of what they feel like is a secure comfort zone, when really, for example, in the last few years, on the average, we found non-multifam asset classes have been reducing typically a couple percentage rates higher than multifam. So, but it varies by market, and it varies by timing cycle. But those are the kinds of things that I think you need a partner, someone to follow, who's doing that research, who's watching those cycles, who knows what's happening with the different asset classes in your area.
Yeah, and I think a lot of people want to invest in real estate, but they are not sure if they're ready. As an example, I used to invest in single family, and then I started investing in apartment buildings. I was very hands-on. Then life happens. I started having kids. I don't have the time anymore to go out and invest. So I would start investing trustee note or syndication, that really you are still investing. You're still letting your money work, but you just don't have to spend that much time to do the investing yourself.
Yep. So if someone wants to expand their real estate investing, what are ways that they can do that?
If they want to expand their investing?
Yeah, if they want to invest, but they only have so much knowledge themselves, what they do.
Well, I'm always happy to talk to them, because we actually, as a matter of fact, most of our clients, again, they don't know where to go, how to start investing. So they are more than welcome to contact us. And my website is www.halengroup.com, and they can also email me. Probably
Haylen.
Yes, and email me is Helen, Helen at Halen Group, it's spelled Haylen group.com.
Okay, so they can find a good broker with experience like yourself, who has the background and knowledge of resources like CCIM, and who loves educating others about and sharing what they know. And they can also find if they aren't ready to make that big a plunge yet, or don't have the resources to, they can go find a syndicator who has the team that can do all of that. Yeah.
And then one of the things for us is that we really want, when we are looking at different options for our clients, we really want to know what is the best for that particular client. It's not like, I just want to sell you a property, let me find your property. It's more like, hey, maybe I have slowed down so many of my clients who said, I want to buy something. I was like, hey, why don't you slow down a little bit? Let's get this settled first. Maybe you can look into trustee note or syndication first. So it's not always like buying a property is the best option for every single one of our clients.